Hello and welcome back to another episode of the Mortgage Musketeer, where today we're going to be talking about USDA loans, rural housing. Yes, had a lot of people asking me for it, so I figured it's time to break it down. Here we go. Alright, USDA or rural housing is a very powerful loan product, and it's something that people think about all the time. Oftentimes first-time home buyers and a lot of realtors will think about it, and they're always thinking about it because it's a zero-down program. So a lot of times they lump that in with first-time home buyers. It doesn't really work that way. Can it help first-time home buyers? Absolutely it can. The issue with a USDA loan is it's not necessarily easy to get. And I'm going to explain all the nuances so that you know or you can learn if you qualify for a USDA loan. So let's start off first of all with what it is. So USDA is the same organization that deals with your meat and the agriculture, all that stuff, but they have a housing component, and they're designed to try and get people who don't necessarily have a lot of income or don't have a lot of down payment. It's helping them get into some of the rural communities and spread Americans throughout America is kind of what it comes down to. So if you're in a city, you could fall in parameters that you don't actually qualify. The house doesn't qualify. So I'll show you at the end of this video the actual map and the website where you can actually go yourself and find out if a home is eligible. So stick around for that. Now, with a zero down loan, that means no down payment. That means you don't have to bring anything. But remember that there's still closing costs and prepaids. Now, like all government loans, with a USDA loan, you can get the seller to pay up to 6% of the closing costs and prepaids. So you can actually walk into a home, if you do it correctly and if it appraises, with no money out of your pocket. And that's why this is pretty appealing. But it has some other aspects to it as well, why it's a good loan. First of all, the upfront mortgage insurance premium, and you will have upfront mortgage insurance premium, and you'll have mortgage insurance because it's a government loan and you're not putting any money down. So it's guaranteed, and that guarantee is supported by the mortgage insurance premium. Now, with a USDA loan, it has reduced upfront mortgage insurance premium of only 1% as opposed to FHA, which is 1.75%. And the monthly mortgage insurance premium is 0.35 as opposed to 0.85 with FHA. So it is slightly lower and can be definitely beneficial. It has the same low rates as FHA and VA, your standard government loans, so it's good in that respect. But what happens is people think this is the best thing that we need to jump into, but you need to be careful, because what I have found just anecdotally is the people who need it the most are often the ones who don't qualify for it. And the reason for that is because you have to thread a needle with a USDA loan in order to qualify. And the biggest piece to that is your income, because it's going to hit you in two ways. One, there's an income cap based upon the actual zip code and the median household income. So they have an income cap, so you cannot make more than that, and they are draconian about that. There are no exceptions. And the other is your debt to income ratio. So your debt to income ratio, you have to have a no more than typically a 29 top end and a 41% bottom end, which means it's really tight. Because usually, and let's focus on the top end where you or the bottom end where you have both your current debt and the house debt combined versus your income. And I will link here to figure out how to figure out your debt to income ratio, and it explains it in detail what I'm talking about here. So let's say that you are sitting at a 43%, chances are you're not going to qualify. Where even with a conventional loan, they can take you up to 49% in some instances, and with an FHA loan, they can take you up to 56% in some instances. Not that you want to go that high with those loan products, but you can get eligible that way. With USDA, technically you can get it to 46%, but you rarely get an approval for that. You would have to have a lot of reserves sitting out there, meaning money in your account that you're not using, and that you got to be careful of too, because if you have 20% of the sales price in your liquid assets, you don't qualify either because it's a zero down loan. So they're thinking to you have enough money for a down payment, you don't need our assistance. So with that said, 41 is very tight. So a lot of people's debt to income ratio will exceed that. If it doesn't, you're good to go. And the same issue on the top end, where it's just the housing payment. So if you don't have a lot of debt, but you're trying to buy a relatively expensive house and you can fit into that 41%, but on your top end you're sitting there at a 35, just with your housing payment alone, you're not going to qualify there either. So it's threading a needle, and we really need to figure that out. And the other piece that I mentioned is the income cap. So there's two pieces of income that they're going to look at. They're going to look at your income cap and your qualifying income. Those are two different things. All right. So a good example of that is I had a USDA loan where I am meticulous about how I figure out the income, and I had the verification of employment before we began. I knew what they had in there. I looked at the pay stubs. They were going to qualify, but just squeaking in under that income cap. But what ended up happening was in underwriting, the underwriters asked for an updated pay stub, and my client had a $750 book stipend, and it bumped them about $36 over the income cap, and they didn't qualify for a USDA loan anymore. That book stipend that the employers gave her made her ineligible for USDA loan. Yes, it is that tight, that ridiculous. And the other thing is there is an income cap, and then there's qualifying income. So you might have been working at a job for less than 1 year, and let's say it's a commission-based job, but you also have a salary. So you might qualify with your salary, but if you add in your commission, you're over the income cap. But because you haven't worked there long enough, for qualifying income, they're not going to be able to use that commission because you haven't been on the job long enough. So two different things. It's very possible that you may qualify with one income and not with the other, or vice versa. So again, your loan officer really needs to dig in there and figure out, do you qualify? So super important when you're actually approaching a USDA loan that you understand it's not easy. You got to really, really dig into it. So anytime somebody tells me, hey, I'm interested in USDA loan, I am going to go through kind of a checklist. Where's the home? How much do you make? What are your debts? I've got to be able to dial it in. And the minute that I pull in credit, I'm going to see something else too. And that's your credit score. Now, technically, like most government loans, you can go below a 620. But it's very rare you're going to get an approval that way. Most lenders actually want to see a 640. Okay? So if you don't have a 640, that's where a broker comes in handy, because a broker or a lender that deals with a lot of investors can shop around and find out if there is somebody who will take it a little bit lower. All right? And if that is the case, that gives you a little bit of options. But you still have to get an approval. And an approval goes through a different system. It's called the Guaranteed Underwriting System, or GUS. And it is very specific to USDA or rural housing. It is finicky. All right? So it will not approve loans that a FHA loan would. And again, that's another aspect where you never know. So unless your loan officer actually runs that through the Guaranteed Underwriting System, you can't trust a pre-qualification or pre-approval. You can't. You have to run it. Because I've seen some of the best looking loans not eligible, and I've seen some funky looking ones that it approves. So you don't know, because what's happening in that Guaranteed Underwriting System is going through the entire application plus your credit profile and determining your risk, right? And it's either going to accept it or it's not. And it's really that simple. Oftentimes, it is helpful, even though you're not putting any money down, if you have reserves in the bank. And what that means is it's not money that we're going to be using, but after you close, they want to make sure that you do have some money left in the bank in case something happens. And typically it goes off of a month's payment. So if your monthly payment was, say, $1,200, then 2 months of that is going to be $2,400 sitting in the bank. All right, so 1 to 2 months is very common to to have a requirement of the reserves in the bank. Okay, so getting a USDA loan, threading a needle, but if you can do that, it's really, really powerful. All right, so the other thing that you want to know is where can I buy one? All right, so let's take a look at the computer real quick. Come on, let's take a look. Okay, so once we get into the USDA website, we're going to go to the single family housing guarantee, because we're dealing with investors or brokers or whoever, and they're doing the loan, but USDA is guaranteeing the loan. So when you click on it, you'll probably come to a disclaimer screen, and once you click on accept there, it'll take you here. Now we're going to plug in an address, and we're going to use we'll just use the office. It's not spelled correctly, but it puts me where I need to be. Okay, so we're in Louisville in this particular instance, and you'll see that the gold or yellowish area is where it is not eligible. This address is not located in an eligible area. And the reason that you have to plug in the address is because USDA is pretty funky. Let's take a look here on the edge of the eligible area and look at Cedar Bluff Court. So part of Cedar Bluff Court and Spruce Hill Road are not eligible, and parts of it are. And this is a really good example. I mean, look at how all these roads are split. And if you plugged in those addresses, you would see that these are eligible and these are not. So the reason that you always have to plug in the address to see if a place is eligible is because of the way that these lines are drawn. So there's no possible way that you can just know off the top of your head. I mean, look how this kind of circles around it. Right? So this area in here actually does qualify, and these don't. So there's not necessarily, I mean, I'm sure there's rhyme or reason to it, and it's based off of population typically. But if you want to know if a house is eligible, you have to plug it in, period. All right, and if you don't, you're playing with fire. So got to plug it in. The same thing if you're listing this house, then you got to know if it's USDA eligible. Excuse me. It is not a top secret thing, so you can. I'm going to leave the link to this address in the description below, so you can go down there and you can see if your home that you're looking at is eligible or not. The other piece that you're going to look in here is the income eligibility. So with income eligibility, you got to be really careful with this, because they are really strict, and if you're not doing your income correctly, then you could think that you're qualified when you are not. So let's just hop into, let's say Pike County. Pike County is out in eastern Kentucky, just to give an example here. What's going to happen is they'll ask you for information. So let's say that there are 4 of you in the home and 2 kids, and there's nobody who's older than 62. And then we go next. And let's say that base employment income for one is $5,000. And let's say that for the spouse that you're going to make, I don't know, say $2,000 a month. Okay? And then we click finish, and you'll see that they're still eligible. Here is what you make, but look how close this is. The maximum is $86,850. So in this particular scenario, let's go back here, and then let's say that when we get the pay stubs, we find out that they're making $5,000 in base income, but they're also getting about say $1,000 in overtime. Now they bust the income cap. They are no longer eligible. So this is why you have to plug it in correctly, because if you don't, you could think that you're eligible and you're not, and your loan officer should be dialing down on this. As a general rule though, you can take a look at this, plug in some numbers, figure out if you might qualify, but then verify it with a loan officer. Okay, So this is super important, this website, and this is what all your loan officers are using for eligibility. And then if you have any questions about this, talk to your loan officer. Okay, so now that you have seen where you can buy a home and you understand how you can look up income eligibility, and you understand that debt to income ratio has to fit in a narrow gap and you need a good credit score, and you also need to understand some of the downside to this. All right, so a zero down loan sounds really great, and it is. You just have to understand that there is risk involved with that. For instance, if you bought a $150,000 house with zero down, you have no equity in that home. So if something happens to the housing market, you could end up underwater. In other words, your property value, if it decreases, your loan amount could be higher than your property value. And generally when that happens, it creates trouble if you had issues making your payment. If not, historically, housing prices will rebound. So you probably won't be underwater for more than a couple years at the most. During the mortgage crisis, I had a home where I was underwater quite a bit and it rebounded. I ended up selling it for profit. So nothing to panic about, but something to be aware of, especially if you don't plan on being in the home for very long. You could end up underwater on that. The other thing to keep in mind is the underwriting process. The underwriting process is very strict, okay? And what happens is every state has their own USDA center where the loans are sent for final underwrite or review. So what will happen is a lender will underwrite the loan to USDA guidelines, and basically they're going to tighten it up. And that's why they're going to ask for everything from you, because they know that they have to take this, bundle up, and send it to USDA. And USDA is essentially going to do a second underwrite. At that point, it really should be a quality control, making sure that everything is correct. But understand that they're going to look at it again. And what that means is that the underwriter doesn't want to have any issues when it goes to USDA, so they're going to be pretty stringent. So if your loan officer asks you for multiple things while you're in the process, there's a reason for it. It's because USDA loans are going to tighten those up really tight so that when they package it up and send it to USDA, it has the highest probability of being approved. Now, can the USDA reject it when it gets there? Absolutely. Which is why the underwriters want to make sure that it's tight and meets the guidelines. The other thing to know is USDA is a government organization. They march to the tune of their own drum. So I have seen underwriting times once it leaves the lender anywhere from 3 days to 3 or 4 weeks. So it can take a long time after you've already gone through underwriting. So it's like being underwritten twice. And during the summer, those timelines jack up. Now you can look on the USDA state websites and find out their turn times for underwriting and get a good sense of it. But know that going in, because if you're doing a USDA loan and somebody's selling their home and there's a lot of other homes, maybe they're selling their home and going to use the proceeds to purchase another home, who's going to use sell that home and the proceeds to buy another. It's a domino effect, right? So if you have a USDA loan and the turn time from USDA is slow, there's nothing that you can do about it. You can't rush it. You can't call them to check and say, hey, what's going on? You can't say, oh my gosh, everybody's lives are dependent upon this. It doesn't matter. You're going to be in a queue, first in, first out. That's how it works. So you have to know that and understand that risk as well. But as long as you know these things and you qualify, it's a fantastic loan. And if your loan officer knows what they're doing, they can hook you up. At the same time, if your loan officer knows what they're doing, they can also eliminate that really quick if you don't qualify. So when I'm dealing with pre-qualification, oftentimes I am always open to the USDA side, but I'm also very candid when I discover that you don't qualify. I don't hem and haw about it. I can tell based off of debt to income ratio or with income, I can plug it in real quick. I can tell where the house is. I can tell real quick. I can kind of eliminate that type of loan. At the same time, I will also tell you, if you looks like you meeting parameters, then I'll let you know. Hey, you meet these parameters, I need to run it through the guaranteed underwriting system. So after we finish with the phone call or the interview, then I will go and I'll get that ran, and then I'll come back and let you know if it approves it. And if it does, you're golden. okay? But if it doesn't, I'll let you know that as well. And most of the time, then you do qualify for an FHA loan. Generally, that's what will end up happening, is if you don't qualify for USDA, you can go into an FHA. And the other question is, if you do have some money that you could put down and you qualify for a conventional loan, would a conventional loan make more sense even though you qualify for a USDA loan? And the answer to that is it depends. Depends on the individual. So that's where your loan officer has to become like an advisor and show you the different loan products and the positives and negatives of both and let you choose. All right? Okay, I hope this was helpful. USDA, a lot of people don't know much about it. It's not really that hard, but you do have to know the regulations. You do have to use the websites. You do have to run it through the guaranteed underwriting system, which is different than all of the other loan approvals. And you do have to be very careful about that income. All right? Okay, so make sure you get your income documents to your loan officer. And I hope this helps. Good luck with your USDA loan. And until next time, that's all for one and one for all.